Hey everyone, welcome back to Corporate Decoder, here to decode the secrets hidden within financial reports like this one. Today we are going to dive deep into Acadia Realty Trust and their 10K filing. Get ready because this one is packed with numbers and a few surprises. Now, let's cut through the jargon and see what this report really tells us about Acadia Realty Trust. This company is all about retail properties, owning and managing shopping centers and street retail spaces in some of the most sought after spots across the US. They're operating on two main fronts, the REIT portfolio, which is their core collection of properties, and the investment management side, where they handle money for big investors through special funds. But it is not all sunshine and steady rent checks. Acadia faces a bunch of risks. They're heavily reliant on their tenants. And if those tenants struggle, especially key ones, it could really hurt Acadia's ability to pay its own bills and distributions to shareholders. Think about it, if a big store in a mall closes, not only does Acadia lose rent, but it can also hurt the business of all the smaller shops around it. Plus, with the rise of online shopping, their retail tenants are facing more competition, which could impact future leases and rental income. Acadia also carries a significant amount of debt, and managing that is always a big deal. If interest rates go up, their borrowing costs can climb, making it harder to manage their finances and potentially limiting their ability to refinance. They have to be really careful with how much debt they take on. Let's look at the financials. Acadia's business is pretty much tied to the retail market. If people stop wanting to rent retail spaces, or if the economy dips and tenants can't afford rent, it hits Acadia hard. They've got a lot of eggs in the retail basket. Okay, now for the numbers. Let's see how they stacked up in 2025 compared to 2024. Rental revenue was up to $402.1 million in 2025 from $349.5 million in 2024. That is a jump of about $52.6 million. This increase comes from new properties they acquired, like getting a bigger piece of that Renaissance portfolio where they now control the whole thing, and from successful leasing of empty spaces. That's a good sign showing their core business is growing. But hold on, depreciation and amortization also went up significantly. It jumped by $18.6 million. This often happens when you buy new properties, as you have to account for the value of those buildings wearing down over time. So while rental income is increasing, so are the non-cash expenses related to owning so many properties. Then we have impairment charges in 2025. These jumped to $37.2 million compared to just $1.7 million in 2024. This means they had to write down the value of some of their investments because they are not expected to recover their carrying amount. Losing money on investments like this directly impacts the bottom line. It's a pretty big jump and something to watch. Looking at the net income for Acadia shareholders, it actually went down from $21.7 million in 2024 to $16.9 million in 2025, despite the higher rental income. Those increased expenses, and especially those big impairment charges, really ate into the profits. Let's see how their existing properties are doing. Their same property NOI, a measure of operating performance for properties owned for the full periods, saw a healthy increase of 5.7%. This is a positive sign, showing that the underlying business operations in their established properties are getting stronger. Their REIT portfolio saw net operating income grow to $157.6 million from $140.3 million in the previous year. That is a solid gain of around $17.3 million, reinforcing that their core strategy of owning and managing high-quality retail is working on the operational side. Acadia's main goal is to acquire properties that bring in cash for their owners and grow in value. They're doing this through two main avenues, the REIT portfolio and their investment management platform. They aim for disciplined growth and improving the quality of their properties. Even with some operational successes, the bottom line for shareholders took a hit. Net income dropped to $16.9 million in 2025 from $21.7 million in 2024. This definitely shows the impact of those hefty impairment charges we saw earlier. And remember that key risk factor we talked about. Their business is really tied to how well retail spaces do overall. If demand for retail space goes down, it hits them harder than a company with a more mixed portfolio. A significant move in 2025 was acquiring a much larger stake in the Renaissance portfolio, essentially taking control. This meant they had to consolidate the whole thing into their financials, which led to that big loss on change in control of $9.6 million. It's a strategic move to gain more control, but it came with an immediate financial hit on paper. Looking at their rental income, most of it is fixed, which is good for predictable cash flow. Variable lease revenue, like percentage rents from tenants, made up a smaller portion. This is typical for retail properties and shows a stable base of income. So, what's the story here with Acadia Realty Trust? They're clearly skilled at managing their existing properties, shown by the growth in their core net operating income. They're actively acquiring and developing, which is how real estate companies expand and create value. However, The big elephant in the room are those significant impairment charges in 2025. This suggests that some of their past investments or current market conditions are forcing them to recognize losses, which overshadowed the gains in rental income and ultimately reduced the net income attributable to shareholders. The retail sector itself still presents risks with the ongoing competition from e-commerce. While they are trying to mitigate interest rate risk with swaps, the rise in debt and the need for refinancing in the coming years are definitely things to keep an eye on. Their strategy seems to focus on prime retail locations in high barrier markets, which can be a strong defensive play during economic downturns. But it also means less diversification. In conclusion, Acadia Realty Trust is a company with a solid operational footing in prime retail markets, but faces headwinds from significant impairment charges and the inherent volatility of the retail sector. The key will be their ability to continue growing rental income from their core portfolio, manage their debt effectively, and navigate the risks associated with their specific niche. What do you think about this filing? Are those impairment charges a blip on the radar or a sign of bigger issues? Let me know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe so you don't miss our next deep dive. Also, join our Discord community, linked down in the description for more direct discussions and insights. Thanks for watching, and we'll see you next time on Corporate Decoder.